New Fed Chair Kevin Warsh gets sworn in on Friday. One of his mandates is to bring down the balance sheet of the Federal Reserve, and the other is to lower interest rates. President Trump has been calling for lower interest rates from former Fed Chair Jerome Powell, and of course, the Federal Reserve has not delivered as much as President Trump wanted. Now, that is going to be very, very difficult because of the inflationary pressures that we've got on the markets. We're now out to, I think, a 96% chance that we will not see a rate cut in 2026. It's going to be a massive focus on how Kevin Warsh is going to deal with his first Fed meeting coming up on June 16th. Hello and welcome to ATFX. My name's Nick Twardale. I'm the Chief Market Analyst. And today we're going to be looking at something a little bit different from the usual geopolitics that are rocking and rolling markets at the moment. But we have got a new Fed chair being sworn in on Friday. There's probably a big difference, and it might make his job a little bit more difficult than he thought, especially with his number one sponsor, which is, of course, the man sitting in the Oval Office. So as we're all aware, President Trump has been calling for lower interest rates from former Fed Chair Jerome Powell for the last year and a bit. And of course, the Federal Reserve has not delivered as much as President Trump wanted. And the feeling in the market was that Kevin Warsh will be brought in, and one of his mandates is to bring down the balance sheet of the Federal Reserve, and the other is to lower interest rates. Now, that is going to be very, very difficult because of the inflationary pressures that we've got on the markets at the moment, all due, incidentally and almost ironically, because of decisions made in the Middle East that have caused inflationary possessions, oil prices to surge, energy prices to surge, and markets to really pull back on any expectations of a Fed rate cut in 2026 and maybe further into 2027. So as we approach Friday, and indeed when we look at the Fed meeting minutes that come out on Wednesday, it's going to be a massive focus on how other Fed members are looking at inflation, how they see it moving forward, and how Kevin Warsh is going to deal with his first Fed meeting coming up on June 16th. Obviously, conditions are tricky. So for someone that's brought into lower interest rates, it is really, really difficult. Last week, we got two key US data updates on inflation. We got CPI and we got PPI. Both of them came in above expectations. We have since seen US yields across the board fly higher. We've got the 10-year comfortably trading above 4.5%, the 2-year the short-term indicator on how the Fed's going to vote, trading above 4% again, which it hadn't done for a number of months. And the longer dated are trading at multi-year highs and sometimes records. So massive interest in what we're going to see from Kevin Warsh. He has got this difficulty ahead, and he's got a Federal Open Markets Committee that he has to deal with. So today we're just going to have a little look at what could be going on, and we'll have a look at some of the charts to see where we could see some short-term trading opportunities, because we've got some updates coming through. We've got those meetings coming through on Wednesday. We've got the official ceremony, I suppose, on Friday. But longer term as well, where we think the dollar could be going in this higher yield environment if it stays put. If we do see a turnaround in markets, if we do see yields coming back, and we do see inflation pulling back, then maybe he's got a chance to get one in. But looking at the odds that the market's pricing in, we're now out to, I think, a 96% chance that we will not see a rate cut in 2026. Some of the other markets are slightly lower than that. But even now, and given what we got from the update from the FOMC last time, we've got a lot of the market looking for the next move for the Federal Reserve to be a hike, probably a 25 basis, let's be honest. And we feel that is coming through into the FOMC. That's something Kevin Warsh is going to have to deal with when he gets on. So without any further ado, let's go and have a look at a couple of the charts. We're going to look at gold, we're going to look at euro, we're going to look at sterling. As always, if you haven't subscribed to our channel, please hit the subscribe button. We'll keep you up to date with all that's going on in the market, including these very interesting upcoming events with the FOMC. So bear with me a second and I'll switch over to some charts. So we're going to kick off with the daily gold chart. Gold has been flying around as it always does, but even more so with what's been going on in the Middle East. But interestingly enough, and this is one of the reasons we're looking at with regard to what we're talking about today, which is the Fed and how interest rates are going to go in the US, it's been moving more on the back of the dollar than it has as a haven trade over the last 6 to 7 weeks, and even longer actually, since that conflict in the Middle East started. So, excuse me there. plenty going on, but really at the moment you can trade gold from that yield side of things, because the higher yields makes it more attractive to get on the dollar side of that equation, because you get income on a daily basis from that. So we've been in a decent range recently, but if we start to see a more hawkish Fed, and this could be something that Kevin Warsh doesn't want to do, but fundamentals leading to it, we could see the dollar appreciate further. We've seen a big appreciation even in the last week or so, from those highs just underneath 4,800 to dipping under 4,500. It did bounce on the back of some dollar selling yesterday. But what we could see as we move through into the next half of the year, some dollar buying come through. If we see inflationary pressures higher, if we see the Fed have to turn a bit more hawkish, could see a break of these support levels now coming in just underneath that 4,500 level. Let's go down to that low at 44.79. A break there could easily take us quite quickly down. 200-day moving average now coming in about 43.50. We've got a good long-term support level. Breaks down here could take us all the way back to that 4,000 level. That would be a longer-term trade, you feel, and that would come with a more hawkish Fed, despite what Kevin Warsh may want to do, and certainly despite what the White House will want to do. So we're going to go and have a look at a couple of probably more shorter-term trades that could come off in the near term, as we hit some key technical levels just yesterday in both the euro and the sterling. So here's that longer term daily chart for the euro, and as I said, we hit some key levels. I'll bring you into a little bit more closer analysis here. So good breaks to the top side in dollar over the last few days and the last 5 or 6, and that's come with yield really pushing higher. It's that bond market taking a bit of a slap on the back that now I feel investors are now saying, look, this issue in the Middle East has gone long enough. We've not seen oil coming through the Strait of Hormuz. Inflationary pressures are here to stay. Higher yields are here for longer. And that's translated over, especially from the US point of view, into dollar buying. That saw this big move down from these levels just underneath 118, the figure. We based out just above this longer term support line around about 116. Look, there the low was 116.07, a little bit of a bounce up to 116.50, but it gives a really good trading opportunity for those Fed meeting minutes coming out on Wednesday, and then any updates we get further from Fed members over the course of the week and from the new Fed chair. So again, hawkish indicators should see these levels challenged. A break here will probably take us down to challenge these lows that we saw. I think these are annual lows as well. They're down here at 114.10. It could be a relatively swift move. Of course, if we see still a bit of a dovish outlook from the Fed, from the meeting minutes that we get, First stop is that 200-day moving average. That's coming in just underneath 117, the figure. But then we're looking to approach those levels, still just underneath that 118 level. So plenty of opportunities for trading in the week ahead on the back of the dollar. And it will be moving. It will be moving on geopolitics, and it will be moving on the back of these updates that we get on the FOMC. They are big updates. They are probably going to have a longer-term leaning on where the dollar goes. But we've got to have a look at it now that we've got that new chair coming in. It's going to be very interesting to see what he says on Friday. I've skipped over to my cable chart. And once again, we had another great move in sterling all the way down from the north of 136.50. We based just about on 130. We did base on 133, the figure. There you go. Decent bounce as well. This is cable. It doesn't do anything in less than a big figure. We know that. But once again, similar trading opportunities, more hawkish outlook, higher yields in the US, more inflationary pressure. Don't forget, we've not really got any key US data this week. So the last numbers we've got, that CPI and PPI data that we got last week. If it remains with the trend, which is down for cable, up for the dollar, then we could see these 133 levels challenged again. Strong longer term support coming in just underneath there, 132.75-ish. Breaks there would open the way back down to 131. So opportunities for trading that. Once again, if there's a little bit of a dovish surprise and we see him coming in and going, no, the next move is down for rates, we could see a nasty knee-jerk spike reaction to the top side. It's clear route really all the way up to those previous highs, 136.33, the trend line resistance, 136.53, and then here we go, 136.58. Some big level just above 136.50 there for cable. So plenty of opportunities in the market, plenty going on. Stay in touch with ATFX. We'll keep you up to date on all that's going on with the FOMC. Thanks very much for tuning in.